Welcome to Sectors Up Close. I'm Elena Casas. Today we're focusing on the energy sector and my guest is Aaron Anderson of Fisher Investments. It's been 2 months since Russian President Vladimir Putin sent troops into Ukraine and investors braced for energy prices to skyrocket as European countries moved to impose sanctions on the world's largest oil exporter. But 2 months on, the European Union still hasn't blocked imports of Russian oil. And yesterday, Moscow shows it still holds the cards, cutting off the gas taps to Poland and Bulgaria to punish them for not paying in rubles. Germany, under pressure to reduce its dependence on Russian oil, says it hopes to find an alternative within days. But as conflict rages, price rises have actually increased Russia's revenue. EU countries have paid Russia $44 billion for fossil fuels since the start of the war, compared to $140 billion for the whole of last year. Brent crude reached a high of $127 in early March, and motorists around the world felt the pain in their pockets. But that price has since slipped back as the supply shock failed to fully materialise, and coronavirus lockdowns in China have sparked new fears about demand. For the S&P 500 Energy Index, there is plenty of upside. It's up 32% year to date, despite a slip in recent weeks. The top constituents here are oil giants Exxon and Chevron, both of which report tomorrow. Well, to look a bit further into the future, I'm now joined by Aaron Anderson of Fisher Investments. Aaron, hi. How much further impact could we see from the Ukraine conflict in energy markets? We saw, of course, yesterday that Russia still retains considerable power to use fuel as a weapon.
Yes, hi, Elena. Very nice to speak with you again. I think it's very likely that some of the stresses in energy markets continue for some time, but I think it's important to distinguish between the types of energy that Russia provides. Gas is clearly a big issue for Europe. That's where a lot of their electricity generation comes from, heating and so forth. And there, simply due to the fact that gas is more difficult to transport than oil is, Russia really holds a lot of the cards here. And so, as you mentioned, if they decide to cut off gas to certain countries, Poland, Bulgaria, that's difficult to overcome. Oil is a little bit of a different story here. Oil can be moved around the world relatively easily. It might take some time, it might add some costs, but the oil complex is likely to remain relatively well supplied. Clearly, there are willing buyers of Russian oil at the right price. And so I think the effects are different regionally, probably more of an impact on Europe, clearly, than other parts of the world. And I think the gas complex is very different than the oil complex today. I expect those tensions to remain very elevated with gas, but I expect a bit more calmness in the oil complex.
In the oil markets, the conflict has led to more calls in the US for oil companies to drill more domestically. Is that actually happening? And if not, why not?
Well, I think US energy companies are being understandably a bit cautious here. Now, they are responding. The rig count in the US is increasing. There is increasing production going on. And I think it takes a while to bring a new hydraulic fracturing rig up and running. That will happen over time, but there's a lot of uncertainty in energy markets today. If suddenly geopolitical tensions calm down quite considerably, and that takes some of the steam out of oil markets, well, suddenly building new infrastructure becomes a lot less appealing. And so I think what you're seeing out of US energy producers is they're headed down that path of increasing production. They're just cautious to invest too much there too quickly if suddenly conditions might change quite rapidly. US producers are a lot more focused on the futures price of oil than the spot price of oil, because it takes a while to build those facilities and get that oil off the ground. And if they're not confident that a year from now oil prices is going to be as elevated as they are today, well, that disincentivizes them to build too quickly.
As you said, crude prices are hugely volatile. For Wall Street, is this increasing the case to invest in clean energy?
I think it is. I think you're likely just to see more desire for energy diversification. I think it probably drives more investment in fossil fuels and in clean energy companies. And so I think it's a bit of a rising tide lifts all boats here. I think unfortunately from an ESG and climate standpoint, the near term is probably a lot more fossil fuel demand. And so I think you've seen a lot of underinvestment for years in traditional fossil fuels. I think that is one of the things that's elevating prices today. I think it drives more investment there going forward. but I think everybody would love to have more renewables exposure. You just can't get that online very quickly. So I expect more spending in both, and I expect that to be a reasonably good environment for equities in both of those types of energy production.
Given the uncertainty, though, in energy markets, how would you advise investors to play the sector?
Well, I think, as I said, unfortunately, from an ESG standpoint, I think the near-term tailwinds probably lean a little bit more towards traditional fossil fuel producers. You're also seeing that crack spreads are quite wide. So things like refiners are getting some tailwinds amid all of this as well. I do think that energy markets remain a bit better supplied than many are anticipating today. I don't expect a huge spike up in oil prices, but we're still at price levels where a significant risk premium in oil probably remains for some time. That works hugely to the benefit of some of those traditional oil companies. And so I think some of the bigger near-term benefits probably flow to traditional energy companies. But as you mentioned before, there's going to be a desire to diversify that energy complex. And so I think renewables are attractive, but the case for renewables is just more challenging. The profitability is a little bit more challenging in the near term. I think that's more of a longer term story, whereas traditional fossil fuels are more of a near-term story.
Thanks so much for that insight, Aaron Anderson, Senior Vice President of Research at Fisher Investments. Well, before I go, here are some of the stories we're following in this space. The European Union said on Thursday it cannot accept payments in euros to Russia for gas being considered complete only once they're converted into rubles. Several companies are trying to work around Russia's demands by opening Russian bank accounts and allowing the Russian central bank to convert payments. The German economy minister says Germany will continue to pay in euros.
The only thing important to me is that Germany doesn't pay in rubles and does not give in to the blackmail, and that we act in European unison. Europe and Germany will pay in euros, some countries may be in dollars and not in rubles. Once the payments have been made, the transformation is then Gazprom's business. This is what we have agreed on in the European Union, and it's the way we will proceed.
OPEC Plus is likely to stick to its existing deal and agree another 432,000 barrel a day oil output increase for June when it meets on May the 5th, sources have told Reuters. The group is unwinding production cuts slowly and is struggling to meet its agreed targets, especially as Russian output has begun to decline. And ahead of tomorrow's results from the US oil giants, French major Total has expanded plans to buy back its own shares to $3 billion after soaring energy prices pushed up its adjusted net income by 32% in the first quarter to $9 billion. But the company had to subtract a $4.1 billion hit to sanctioned investments in Russia, where it continues to maintain assets. And that's your roundup of the energy sector. I'm Elena Casas, and this is Reuters.